of 2019 brought much needed relief for investors following a rocky finish last year. Most global stock markets are off to a strong start so far this year, but what could the second quarter have in store? And there's a few clouds on the horizon. I'm joined on the line here by Lukman Otunuga, a research analyst at FXTM, who joins us for a lot more. Now, I'm told one of the big things we've got to start worrying about is the inverted yield curve, which I'm told is a portent of recession to come. What should we be looking out for?
Thank you for having me here today. Yes, historically, when the yield curve inverts, it is a signal that suggests that there's an impending recession within the 16 to 18 month. And this is why when the yield curves inverted back in March 22nd, there was a lot of panic across equity markets, but we need to look at the bigger picture. Yes, global stocks are pushing higher due to optimism over United States and China coming closer to a trade deal, but there are many geopolitical risk factors out there that we need to keep looking closely at.
Well, I mean, the World Trade Organization, as I was mentioning here on the show, has slashed its projections to the weakest predictions in 3 years. There's a lot of worry that 2019 could see yet another recession.
Yes, that's a very important point that I made, and this continues to revolve around, number one, ongoing US-China trade developments. For an extended period of time, we've been saying that trade tensions between the United States and China is a significant threat to global economic growth and stability. This is why, depending on how the talks play out in Q2, this could really shape out how 2019 plays out.
Well, what's your prediction on the US-China trade talks? They talk about progress, there's talk about how it could pep up the economy. How are you reading it?
Well, this week we can see there's been a lot of optimism over both sides coming closer to a trade deal. But how many times have we seen this happen where it looks like a trade deal is in a line, then in the last minute, almost everything falls apart? So I think markets and investors should be very diligent on this. If a trade deal does become reality, this will be very positive for market sentiment and is seen supporting global equity markets. However, though, if this is another repeat of what we've seen in the past, when trade talks do fall apart near the end, risk aversion could prevail and stock markets across the board will take a hit.
Indeed. Was it they say when two elephants fight, it's the grass that gets crushed? Right, so, and a bit closer to home here, I mean, the Moody's decision to skip a decision on Friday, the RAND seems to like it. It's been called a shot in the arm. What do you think it's going to do for the markets here?
Initially, there was a collective sigh of relief after Moody's decided to postpone the ratings. But I've been reading reports that actually Moody's stated that it's still an investment grade. So this is quite positive for market sentiment in South Africa. Naturally, this positive sentiment will continue to support the local markets and the South African rand, which continues to perform quite well.
Okay, so quarter two, looking ahead, you think we should be a bit more cautious or a little bit more optimistic?
Are we talking about South Africa here?
Yeah, we're talking about South Africa first, the rest of the world after.
So when we're looking at South Africa, I've been paying very close attention to the rand. So overall inflationary pressures in South Africa seem to be moderating and the rand is performing well. So all in all, I believe this would actually allow the South African Central Bank actually's next policy move to be a rate cut in an effort to support economic growth. Naturally, when we're talking about domestic factors, externally, trade developments, global growth and other geopolitical risk factors will also play a leading role in shaping South Africa's outlook in Q2.
Well, speaking of which, just a final quick question for you. I mean, we have elections coming up next month, May the 8th. What's the hope afterwards that you're going to get a strong government with a strong mandate to sort out this economy?
That's a very interesting question, and I'm still, myself, closely watching this. Let's see how this plays out.
Okay, well, also, again, there's a lot of a drive for investment at the moment, as you've been hearing with the previous guest. What do you think the prospects are for foreign investment in South Africa right now?
I mean, we could speak about South Africa, but I think it's in general emerging markets. This is more of a emerging market theme. Naturally, if we do have a situation where, you know, market sentiment is improved due to the possibility of US-China, you know, US and China securing a trade deal, and we have confirmation that actually global growth is not really decelerating, but is actually stabilizing. This naturally will improve appetite for emerging markets, with South Africa falling into the category.
Well, thank you very much, Lukman Otunuga, the research analyst at FXTM. And after the break, we'll be finding out what economists think of the so-called free pass that Moody's gave South Africa.